Just yesterday in the S&P 500, we see a lot of red in the market with the major focus on Nvidia down more than 3%, which has started to bring the wider market down, although this is giving us an opportunity to buy some undervalued dividend stocks near their 52-week lows. As always, we're going to look at the historical performance of each company. We'll look at their dividend safety score. We'll run into some of their metrics, their free cash flows, their ROICs, their debt levels, and we'll run each and every one through our own valuation model, getting to our intrinsic value as well as our acceptable buy price. Now, we will also incorporate an investor margin of safety and see how much upside is Wall Street predicting for over the next 12-month period. So the first one we're looking at is BMY, Bristol Myers Squibb. Now, we do get a buy rating from Seeking Alpha, although we do note a double hold from Wall Street and Quant. As we mentioned, trading right there towards their 52-week low and a forward yield of around 5.72%, which does make it attractive for those dividend investors. And we can see hammered down 36% over the last 12 months. Over the last 10 years, if you have been a shareholder, you would be down 16%. Even if you were to reinvest those dividends, it would be marginally higher, still making a poor investment over the last 10 years. But bear in mind, past performance is not an indicator of future performance, and we can see all-time highs around $81 nearly 2 years ago. In terms of their dividend safety, well, it does look to be safe. It has a score of 70, market cap 85 billion. It is a large cap company as well, and it was just reaffirmed last month, dividend safety 70, meaning a dividend cut does look to be unlikely. Now, in terms of the last recession, how did they perform? Well, we can in fact see they maintained the dividend during the 07-09 Great Recession. They had negative 21% recession sales. Remember, that is below the average of the S&P that sat at negative 12, but they did significantly outperform, negative 32, with the S&P negative 55. Dividend growth for a nice dividend yield company is pretty strong, 5.3% in December last year. Do bear in mind, on this channel, we want to see a minimum of 4% to keep up in line with inflation. Last 5 years, a nice high single digit at 7%, and over the last 20 years, at a bare minimum, they are keeping up in line with inflation. And we can see not only have they been increasing the dividends for the last 17 years, they have been paying a dividend for the last 53 without a reduction. Now, as always, dividend yield theory does state a company is undervalued when the current yield sits above the 5-year average. 5.72, that is a severe undervaluation signal, the highest yield they have offered over the last 5 years, above 3.15, and we also note their forward PE 6.1 does sit below the 5-year rolling of 8.9, a double undervaluation signal. In fact, we do have a triple undervaluation signal with the healthcare sector sitting much, much higher at 16.9. Just bear in mind though, we don't look at any of these models in isolation. We will conclude towards the end. In terms of the free cash flow payout, it is one we do focus on as the earnings is susceptible to manipulation by management through accounting. Below 50% to be industry specific for biotechs, my own blanket rule below 60%. And in fact, from 2018, it has been below 50%. Very strong, 38%. We do like to see that. 35% over the next 12 months, meaning we should expect above inflationary increases moving forwards from BMY. In terms of free cash flow per share, well, very impressive, because what we want to see is consistent increases year on year, which we do see for the majority of the last 10 years, going up nearly 4 times over the period. 611 in 23, anticipated over the next 12 months to continue to 683. In terms of sales growth, well, as always, we want to see around 3 to 7% growth year on year. It has been very inconsistent, some very strong years, notably 2020, but over the last 2 years, we have seen some very mediocre performance. In fact, 2023 down 2%. In terms of their total sales though, we do note they have increased their top line 3 times over the last 10 years, but we can see just over the last 4 years it has remained fairly stagnant. In terms of shares outstanding, what we want to see on this channel, companies that do return excess cash through those share buyback, 1.67 in 2014, 2.05 in the latest period. What this signals to us, effectively, they are diluting your position as a shareholder, something to factor in maybe to the margin of safety that we will come on to shortly. ROIC, as always, return on invested capital, very important metric. We want to see a minimum of 10% to give us faith management are able to effectively allocate their capital. Above 25% for biotechs, again, my rule 10%. We can see they have been above that over the longer term, especially over the last 3 years. Trailing 12-month 11%, also looking fairly solid. We then move on to the margins. Biotechs, we do increase this to the typical numbers we look for the majority of companies. Above 25%, it has straddled around that, not too far. 19% in the more recent year. We would like to see it inch up closer though to that 25% level. Free cash flow margin looking very strong since 2018, above that 20%. 28 in 2023. We then move on to the net debt to EBITDA. Now do remember this is the earnings before interest, tax, depreciation, amortization. Below 1.5 for biotechs, and these numbers that you do see below represent the number of years it would take the company to pay off all of their debt net of cash on hand. 1.63 in 2023, so not too far off that level, but we can see it increasing to 5.63, so something just to bear in mind that will affect that dividend safety, as well as hampering onto that balance sheet strength, as it does correlate to both of those figures. So let's jump into the valuation model of BMY. As always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically on this channel, we do run through every single one of these models to get to our intrinsic value. Today's episode, we're jumping straight into it, and it does come to a value of $53. Now the current price around 42, we always use a margin of safety. Now remember, we only execute on 10% if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that, then it is above to $47. Then we keep going till it's near the current trading price. And we can see in today's episode, it does have a 20% MOS level at $42. In terms of Wall Street, well, they also believe the share price pretty much bang on our intrinsic value. They see that over the next 12 months at $53. They do have implied upside over the next year at 26%. And as always, let us know your thoughts about these companies as we go through them today. Now, before we run into the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment. You can start reading straight away. For example, if you want to see how we find undervalued stocks, all the screeners, websites we use, or if you want to see our latest article on 12 undervalued high quality companies, you can go read that straight away, free and instant access. The next company we're looking at 52-week lows, Intel Corporation. Now it is down around 6% over the last 12 months. If you've been a long-term shareholder, well, we can see pretty much flat over the last 10 years. So if you do incorporate inflation, you will have lost a lot of purchasing power. And we can see all-time highs sitting around that essential $68 level, April 2021. As we mentioned, right there towards its 52-week lows, another buy rating from Seeking Alpha, a double hold with a forward yield of 1.61% and a forward P of 28.3. Do bear in mind, S&P does sit around 22.5. But as always, we will compare it to the sector P for more relevancy. Now, dividend safety score 50, borderline safe. Do bear in mind they did have a recent dividend cut. Market cap 132 billion, a mega cap company. And in fact, they were downgraded just last month to borderline safe, indicating there is a moderate risk of a dividend cut over a full economic cycle. Now, in terms of the last recession, how did they perform? They maintained the dividend, they had below average growth, and they only marginally outperformed negative 49%. Well, they haven't increased their dividend yet, so we are waiting on an increase this year. As we can see, due to the dividend cut, on average, over the last 5 years, it is down 9%. But over the last 20, it is up 12. And as we can clearly see here in 2022, that dividend cut into 23. Hence why we do see 0 years of consecutive increases. Now, in terms of dividend yield theory, we can't particularly use this model now due to the fact they did have a dividend cut, so the data is skewed. But we can see the 5-year average is 2.45. And when we do focus on the forward PE, it does sit higher, 24.6, than the 5-year rolling of 13.5. Although we do note the information technology sector PE does sit higher at 26.4. Now, in terms of the free cash flow payout, what we will notice here is whilst we do look for below 50% for semiconductors, it is negative in 22 and 23 due to the fact that their free cash flow for this period is looking negative. As we can clearly see here, it was increasing from 2014 to 2020, but we do notice the dip down into 2021 and into the subsequent years, so something just to bear in mind in your own investment thesis. In terms of sales growth, well, again, up to 2020, it was looking fairly solid, at least that 3 to 7% mark. Over the last 2 years, though, they have taken a massive hit to their top line. hence why we do see it go from 56 billion in 2014 to 54 in 2023. What they have done, which is quite nice, are some share buybacks from 2014 to 2023. The only thing we will point out though is in 2021 they did reverse that, and we can see, although marginally, they have started to dilute your position just over the last few years. In terms of ROIC, well, as always, 12% or more for industry specific. We do note looking very strong up to 2021. The last 2 years though looking fairly questionable, and again we will come onto that margin of safety so you can see, if you do believe this to be a company to buy, what sort of level you need to be looking at. In terms of the operating margin, well, above 16% isn't what we see over the more recent period. Prior to that though, looking very strong, very healthy, and the same tune to be said when looking at that free cash flow margin. In terms of the net debt to EBITDA, then below 1.5 for semiconductors, 2 in 2023, so it is above that level. Probably one of the reasons why we do see that downgrade to the dividend safety and borderline score, but nice to note in 2024 it is anticipated to come down, although marginally. Hopefully though, this is a trend that we can see over the next few quarters as well as the next few years. So let's jump into the valuation model, and as always you can click on the pinned comment below to grab a copy of this valuation model, getting to both intrinsic value as well as acceptable buy price of companies in your own portfolio. Now we have removed the DDM model from this analysis for Intel, given they did have that dividend cut, so it will have skewed the data slightly. Intrinsic value coming just under $36, current price $31, MOS level then at 10%, it is a buy up to $32.20. At 15%, it isn't quite there yet, so it's not too far. We're talking about 59 cents, so you could argue Intel is trading at that 15% MOS based on the estimates and judgments. In terms of Wall Street, well, they are very bullish on this stock, as we can see with their target price. They have upside of 28%. They believe this share will be trading around $40 over the next 12 months. We then move on to a very high quality company. It is MSCI with a double buy rating, although a hold from quant, trading right there towards their 52-week lows with a yield around 1.32%, a forward P of 33.09, and it is up, although very marginal, 2.5% over the last 12 months. Over the last 10 years though, an incredibly strong performance, up 976%, and we can see all-time highs though sitting around that $665 mark. In terms of dividend safety, well, 61, it does look to be safe. Market cap 39 billion, a large cap company, and it was just reaffirmed just last month, safe score indicating dividend cut unlikely. Now in terms of looking at dividend growth, that is what I love to see. Double-digit increase just this year. Double-digit increase, 24% to be specific, over the last 5 years, and they have been increasing those dividends over the last 9. In terms of dividend yield theory, well, we do get that double undervaluation signal, the yield higher than the 5-year rolling, as well as the forward P, 32.5. We can see the averages around 40.9. In terms of financials though, the sector does sit much low at 11.1, although you could argue it is warranted for MSCI to be trading as high or higher than the sector due to the quality of the metric. In terms of the free cash flow payout, well, below 60%, even though it is marginally increasing, still below 38 anticipated over the next 12 months. Free cash flow per share, this is what you want to see. This is one of the model companies for the free cash flow, increasing year on year. Again, that upward trend is anticipated to continue over the next 12 months. Sales growth nearly double digit every single year, so again, very impressive, 15% on a trailing 12-month basis. And when we do come to look at the sales, again, more than doubled over the last 10 years. And more good news, as we can see, they have returned a lot of excess cash, giving you a larger portion of control of the company, reducing those shares on a year-by-year basis. In terms of the ROIC, well, not only is it above the minimum 10% that I want to see, but it has been increasing over the longer term. This is what we truly call a very high-quality company. Margins, again, very, very impressive. We're talking about operating efficiency. It has increased 34% to 55%. And one of the key things that I want you to understand when looking at companies, not just that they're increasing their revenues, every company can realistically do that if they are of a good quality, but high quality companies, they also need to be increasing those margins over the longer term. We also note free cash flow, absolutely gorgeous. We're talking about in the 40s consistently over the last 6 years. And on a net debt to EBITDA basis, maybe one area they could improve, perhaps why we do see that safe score instead of very safe, below 3, 2.7, so a little bit too high, although we can see coming down to 2.38, and this is definitely one that I would look to consider for the portfolio, just purely off that very high quality. But as always, it does need to be sitting at that right price. So in terms of the intrinsic value today, $589 with a price of $486. At 10% MOS, we do see it up to $530. At 15%, $500. at 20%. It isn't quite there yet, not too far off it, so we do see it somewhere between 15 to 20% for what I would call a very high quality company. And in terms of Wall Street, well, they believe the share price isn't too far off the intrinsic value over the next 12 months, giving it upside of 20%. And as always, let us know your thoughts on these companies as we run through. We then run through the Hershey company. We did do a deep dive if you want to see that just last week. We have a double buy rating, although a hold from Wall Street, trading right there towards its 52-week low. Down 30% over the last 12 months. Again, the rising cocoa prices have really hurt this company, although you could argue it is starting to slow down. It is up around 89% over the last 10 years, with a yield now of just over 3% and a forward P sitting there at just under 19. In terms of the dividend safety, well, a score of 80, market cap 37 billion. It is a large cap company, and again, reaffirm that safe score, dividend cut looking unlikely. Now, last recession, unfortunately, they didn't increase the dividend, but they didn't cut it as well. They maintained it. They had above average growth, and they also significantly outperformed the S&P, negative 30%. Love to see double-digit increase this February, double-digit increase over the last 5 as well as the last 20 years. In terms of dividend growth streaks, well, 14 years of consecutive increases whilst paying a dividend for the last 94 without a reduction. In terms of dividend yield theory, absolutely no surprises. An undervaluation signal on the yield, probably the highest it has offered over the last 5 years, and on the forward P, 19.2 versus that 24.3, and we can see though it is marginally higher than consumer staples sector at 18.0. So in terms of the free cash flow payout, we want to see below 70. We do lift it a little bit higher for consumer staples, 59% in 23, 53 expected over the next 12 months, so no worries with that at all. Again, even lower than our blanket 60% rule. Free cash flow looking very strong. It has been increasing over the longer term, very minimal inconsistencies year on year, and again, over the next 12 months, that is expected to continue. In terms of sales growth, well, again, very strong in the more recent years, the last 3 looking very nice, although prior to that, we do see some years as well as some periods where it was fairly poor. Over the longer term, though, we do note their top line is up around 50%. They do some share buybacks, very trivial, so not much to discuss. They have reduced it from 225 down to 205 in that latest quarter. ROIC, well, very strong, even though it has been declining in the mid-20s over the last 6 years, so that is very positive. 28% as well on a trailing 12-month. As always, these metrics make it incredibly attractive to potential investors. Operating margin, well, we love to see this, as we just mentioned for MSCI, operational efficiency increasing over the longer term, and their free cash flow margin looking very, very good, consistently above that minimum target. In terms of the net debt to EBITDA, well, below 4 for consumer staples, no worries, consistently below, in fact, pretty much nearly below 2 every single year, 1.67 anticipated over the next 12 months. In terms of the valuation model for Hershey, the intrinsic value that we did get to today, just over $208, with the price coming down over the last few days at 182. A 10% margin of safety would indicate a buy up to 188. At 15%, it isn't quite there yet, but it isn't too far off. And for me personally, if it does get to that 177 level, it does look like a very strong buy to add more to the portfolio. So between 10 to 15%, Wall Street are indicating over the next 12 months, again, their share price isn't too far off our intrinsic value. They believe 14% over the period. We then move on to McDonald's, which has also been around that 52-week low period, hovering there significantly. A double buy rating from Seeking Alpha and Quant. It is trading with a yield of 2.58%. A forward P marginally lower than the S&P at 21.25. Again, right there heading towards its 52-week low. Down 12% over the last year. Over the last 10 years, though, it is up around 147%. Now, in terms of the dividend safety, while 77, it does look to be safe. Market cap 187 billion, and it was reaffirmed that 77 safe score last month. In terms of the last recession, while they increased the dividend during the Great Recession, they had negative 6% sales, so above average, and they significantly outperformed the S&P, negative 3%. That is why we do call this and consider this company to be a recession-proof stock. Now, in terms of dividend growth, 9.9% last year, 8% over the last 5 years, double digit over the last 20. Again, a nice dividend growth company as well. And they are 3 years away from entering the realm of dividend king status. Now, in terms of dividend yield theory, No surprises as well, undervaluation signal on both the yield as well as the forward P there, 21 versus 25.4, although we do see it significantly above consumer discretionary's 14.2. In terms of the free cash flow payout, below 50% for restaurants, it has been significantly higher year on year. Nice to note the downward trend, 56 anticipated over the next 12 months. So again, hopefully next year we do get a nice double-digit increase. Free cash flow per share, while increasing over the longer term, more than doubled in fact, upward trend anticipated to continue into $12 per share. And in terms of the sales growth, well, very mixed. They went through a very poor period from 2014 to 2020, although the last 3 years, in fact 2021 specifically and 2023, the more recent year, have looked very strong. Numerically though, we do see this business $27 billion in 2014, down to the lows of COVID-19, and since then it has rebounded. What is nice is those share buybacks. We can see 986 to 730, although some years they do a lot of share buybacks, other years are very minimal. Now we move on to the ROIC, and as always, consistency is one thing we love to see, and that is what we get to see above 12% consistently in the mid-20s over the last few years and on a trailing 12-month basis. Operating efficiency above 16% and continuing, it's gone from a massive 29% to 46% in the more recent year, and again, free cash flow machine, just love to see this, 15% in 2014, 29% in 2023. Net debt to EBITDA, probably one area we would like to see them improve. 3.5 for restaurants, 3.13 in the more recent year. Pretty much expected to have minimal movement over the next 12 months. Just something we would keep an eye on with MCD. In terms of the valuation, well, let's get to it. Don't forget you can grab a copy of this model by clicking on the pinned comment below. 301.73, current price 259, and with a 10% margin of safety, we do indicate a buy up to 272, 15%. Pretty much around that current trading price, 256, so a few dollars shy. So McDonald's, we do see that 15% margin of safety based on the estimates. Now, Wall Street, they are forecasting this price, in fact, to go higher than what we've calculated. They do see a lot of upside, 20% to be exact. And as always, let us know, is this one you have been buying just over the last week, where we did see it dip even further than that 259 we see today. This then brings us on to UPS, where we do have a double buy rating, a hold from Quant, and this company seems to be falling further and further every time we take a look, down 21% over the last 12 months. In the last 10 years, it is up around 33%, so pretty poor, but we do see all-time highs sitting around that $225 level around January 2022. Again, right there at their 52-week lows, we do see a forward yield of 4.77% and a forward P of just under 17. Dividend safety score, well, 69, it is looking to be safe. 117 billion mega cap company, and we can see reaffirmed last month dividend cut looking unlikely. Now, last recession, in fact, they maintained the dividend, they had average growth, and they marginally outperformed with their negative 48% return, and one of the worst dividend increases from this company just this year, 0.6%, probably just to keep up in line with those dividend growth streaks, because we have seen the last 5 and last 20 double digits. That is one reason why we were extremely disappointed this year. Now, they have been increasing those dividends for the last 14 and paying a dividend without a reduction for the last 55. Now, in terms of dividend yield theory, we do get, and no surprises, a significant double undervaluation signal. That yield, pretty much the highest they've offered over the last 5 years. In terms of the forward P, 15.6, it is marginally lower than the 5-year average, but it is significantly lower than industrials as a whole at 19.2. In terms of the free cash flow payout, this is where we would say just be wary, and one of the reasons why we do focus on the free cash flow. 110% in 2023, indicating that management paid out more in dividends than they did generate in free cash flows. You wouldn't be able to see that from this figure on the earnings payout. 2024, we do expect this to continue, so next year as well, just a red flag indicator, we're not expecting a very large dividend increase. In terms of the free cash flow per share, well, it has increased over the longer term, very inconsistent. Over the next 12 months, it is also expected to drop down to around 460. In terms of sales growth, well, actually pretty strong across the board, other than the more recent year where it did drop down to negative 9%. But if you do want a deep dive, we have looked at UPS not too long ago, and we have discussed a few new contracts that they have now received, hopefully to help bolster their top line, which, as we can see, gone from 58 billion to 91 in 2023. Now, similar to the previous companies we reviewed today, they have done some share buybacks, although very, very trivial year on year, but something just to note. In terms of ROIC, well, even though we do see this decreasing over the longer term, 20% in the more recent year is still fairly strong. Hopefully though, they can continue to go back up to the levels we have seen in the mid 40s to mid 50s. In terms of the operating margin, well, very inconsistent. We want to see around 12% at a minimum. It has been straddling on that year on year, 10% on a trailing 12-month basis. And in terms of free cash flow margin, 5% or more, and what we are seeing here is again straddling around that level. So in terms of the net debt to EBITDA, then below 3, and in fact we do see that it does have a fairly strong balance sheet, 1.58 in 23, 1.49 anticipated over the next 12 months. It is just a bit of a worry that they are paying out more in dividends than they are generating in free cash flow. But let's get to the valuation model. As always though, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value then $162, 10% margin of safety, buy up to 146, at 15% up to 137.90. So it is pretty much trading at a 15% margin of safety. At 20% around $130. Now it does really depend on what sort of MOS level you are looking at. As we saw, a lot of the metrics for this company did look a little bit worrying. So I would personally, if I was to consider, would be wanting a minimum of 20% around $130. As we see though today, it is trading at that 15% level. In terms of Wall Street and their expectations, well, as we can clearly see, $163. They do see upside of 20%, and again, not too far off our intrinsic value. As always though, do let us know your thoughts in the comments below. Are you adding to any of these? We did run through Bristol Myers, Intel Corporation, MSCI, Hershey's, as well as McDonald's and UPS. And as always, if you enjoyed the episode, smash that like button. We'll see you all on the next one, and for now, take care.